All right. Welcome to the video view from here, the beta test. This is my first time doing this, so bear with me. I may not necessarily do everything exactly the way I would hope to. May have to stop and start a little bit, but overall I'm hoping to be able to do a video instead of stay up all night trying to put a text version of my thoughts up on Use ThinkScript. Instead I'll put a link to a video. And that way you can sit back and watch, and that way I can basically touch on all the points I would hope to, as opposed to forgetting different things that may be important to the overall scheme of things. But anyway, let's start. And where do we start? We start with just a pure price chart and the Fibonacci's. There's no way to hide them and quickly bring them in or drop them off. So they start out with everything else right at the very beginning. So we're looking at a 1-year daily chart, and it's zoomed into about 5 months worth of data. And what else? See, this is where I've got to work on the overall dialogue. But if you just hang in there, I'll see if I can get us going in a good direction and hopefully convey some information that may help you. I know it helps me. Okay, so first thing we want to do is we want to build the chart. We start out in the very beginning and we just go and add some studies. So let's go up to the studies. And what we got everything turned off right now. So the first thing I would throw on there is the auto channel. Gives me a long-term sense of where price is headed, as channels tend to do. The next is the adaptive trend flow, which is something that I got off of Use ThinkScript, and I appreciate that. There's so many things that I got off of Use ThinkScript that I was able to evaluate and apply. And it's an amazing resource. And I thank Ben 10 and Mary Day and Use ThinkScript and the rest of the moderating crew for putting together a great site. So let's just turn on the auto channels for a minute. Alright, so what's it showing us? It's showing us that M&Q is generally in an upward direction on a yearly chart, or a year daily, that is. And what happened? Came down pretty hard and based on the lower channel. Gathered a little bit of steam and popped to the upside, but just a counter trend rally. It's going further down. That's what the reaction is here. The sellers just jumped on top of things and just gleefully took things to the downside. So that's the channel. Let's go back up. And we got, like I said, the adaptive trend flow. Which brings a little more color to the chart. There we go. So we have the mean in the middle. Line just kind of moseying along. Then we have the standard deviations. And we have 2 standard deviations, and we have 3 standard deviations. And when price gets into 3 standard deviations, that's a pretty good indication that you're going to reverse at some point. It may take a little while, and that's the hard part. You can't just use it by itself. But you can use it as just a rough gauge of where things are at. Like here, price was popping into the 3rd standard deviation. And what did it do? The Fed comes out like they do, make a pronouncement, and the market just tanked. And what did it do? It went down to the other standard 3rd standard deviation base, and then bounced back towards the mean. And that's for you mean reversion folks. I tend to do more trend following than I do mean reversion, only because it's more work to do mean reversion. But anyway, okay. That's just a quick overview of the adaptive trend flow. I think that's what we call it. Let's see. Yes, the adaptive trend flow. I think I can thank Sammer 800 for transcribing so many TradingView scripts, Pine scripts, into ThinkScript. It's just enormous contribution that he made. You know, he's got a new job or something. I wish him all the best with that. All right, so let's throw an EMA on there, because moving averages always help. So we throw the EMA on, and we apply that. And it's a daily 233. A lot of people focus on a 200, and I don't know why. It's not a fib. 233 is a fib, and it seems to fit. At least I think it fits better than a 200. But people get into standard routines, and everybody's kind of looking for answers based upon what other people are saying. And I can understand that. When you don't know what you're doing, you're going to tend to want to find somebody who can give you some answers and then take that information and run with it. But I think what it really comes down to is doing your own due diligence. You know, I've gone through, I think I might have mentioned here recently on one of the posts that I made, that I've gone through over 2,600 indicators looking for the ones that are going to work for me. And I think I might have already found them and subsequently shared them. So they're up on Use ThinkScript. If you want to take a look, try it out, see if it works for you. All right, so we got an EMA up there now in green. Everything's wonderful. Moving to the upside, and all of a sudden, bam, price closes below, comes down, and the EMA goes red. And with this latest counter trend rally, it didn't even make it up to the EMA, so that was a pretty good hint to weakness. And down it's come. And where does it come down to? That third standard deviation. So it's going to bounce. It's just when. And I have to admit, I'd be the first to admit, this kind of move took me by surprise. When I saw this candle here, I knew the selling was in. The sellers really pushed it down, but I didn't think we'd get a reaction like this. And everybody's talking about the interest, not the interest, I'm sorry, the inflation rate. Oh my God, it's inflation? Well, as far as I'm concerned, the inflation ticked up from 0.3% to 0.4%. But the media, as they're apt to do, they want to get eyeballs, so they make it out to be more than it is. And it's moving in the wrong direction. It went up, but I don't think it went up that much to create this much of a push to the downside. So, in any event, let's go back up, see what else we got in the toolbox. That's pretty much all there is for the on the chart itself. Excuse me. But we'll go and we'll start throwing on the studies, the lower chart studies. And the first, to me, is the most important, is volume. And it's not because I came up with my own way of looking at volume. And it's totally not my own way. It's been influenced by others who've come up with ways of looking at volume. But you need to look at volume in terms of price. And if you don't, you got to put it up on the chart. You got to get used to it, because price and volume are probably the only two leading indicators that we have available to us. But let's apply it and see what we got. All right. Got squished a little bit. There we go. Auto arrange. There we go. That's a little better. So what do we have here? Well, we have the volume itself in terms of the total volume, and then the selling volume and its pressure. None of this is actual volume. That's another thing that kind of tweaks me about just Thinkorswim. Why we can't have real volume. I I mean, I imagine it was a decision that they had to make when they were putting the program together, but to me, volume pressure is kind of a abstract, but we'll work with it. So this is the regular volume. Then the red and the green lines are the averages. And you've got red as average selling and green as average buying. And what else do you have? Well, you have the interaction of the two lines and as it relates to price. And then you have volume itself to give you a further hint of what's going on. So what do we have? Just take it right from here. We have a peak in buying volume or buying volume pressure. And then we have a trough of selling volume pressure. And you can see right on the bar right here that there's more total volume than there is selling volume, which would make sense because there's selling volume and then there's buying volume pressure. Keep on, you have to remember to say pressure. And we go up, and that's pretty much what happened candle-wise. Overall, it sold off, but it came down, and then the buyers came in and pushed it back up. And the very next candle, the buyers just gave up, and the sellers just swamped and brought it down. But anyway, getting back down to volume, that's what we're dealing with. And then we see, like I said, the buyers gave up. The sellers just totally overwhelmed the situation. And as a result, the buying pressure came down and selling pressure started climbing up. And as long as that selling average, the average selling pressure, climbs, price comes down. Because you just have more sellers than buyers. Even though it's a one-to-one deal, it's still a situation where you have more selling than buying going on. So what happened? The average buying continued on its way down. The average selling continued on its way up. Came to a peak here, and that's the first wave. All selling bars coming down till we got a counter trend rally. And what counter trend rally? Well, you had a huge amount of selling going on and then countered by almost significant or almost as much buying. People are thinking, okay, we're done. We're going to go to the upside. Buy the dip. Unfortunately, that's not quite the dip yet. Where do we go from here? Well, price opened higher than the previous close, but sold off. And that's a good pointer to the fact that we're going lower. And you're right at the 233, so you got support. So you're going to wait on a break of support. And where does support break? Well, you got another little counter trend rally here. But what do you have? You have a peak on the average buying here. It's almost a doji candle. And it's right around the 233, so it's finding support. Then at weekly, not weekly chart, but it's weak, it's going lower. But how do you know it's going lower? Well, once again, the average selling is over the average buying. Even though the average buying is climbing and the average selling is falling, it's still over, which means that there's still more selling going on. And that's why even though you have solid buying candles here, they're really not that solid, and it's going further down. Now, it's easy for me to say that it's going down when I have the price in front of me and I'm just looking historically at the situation. I have to say that, as a disclaimer, obviously. But I'm just trying to give you a sense of how volume is working in conjunction with price to give you an overall sense of the trend. So even if I took away the price action, maybe I'll do work on that for the next video. Take away the price action here and just advance one candle at a time. I'd basically be able to show you that that's the interaction that's going on between volume and price. So we could follow along here, and interestingly enough, the averages kind of get intertwined here, which gives you a sense it's a chop. There's no real trend going on here. It's just wrestling with the lower channel as it tries to move to the upside. And I come back to the latest sell-off that we had on Friday, and where this is overall positioned, and I'm of a feeling that I may be buying a little bit heavier here on a bounce, and as a result probably playing a mean reversion as opposed to a trend reversion. But make a few bucks trading the day as opposed to going longer term. Even though on my signature on use ThinkScript I say that I'm a swing and position trader, which is what I really try to be. It's not that I won't take day trades if they're productive and positive and profitable, most of all. Okay, let's go back up, see what we had next. Anchored momentum. Thanks to Lazy Bear, came up with this one. I think it's a great tool. It's just auto arrange. Okay. Now this one I added relatively recently, so I don't know everything frontwards and backwards in terms of how it works. But at the same time, I can look at it enough to see that it works very nicely. Whereas you're kind of having to do a little more interpretation of the averages on the volume and the volume itself. You pretty much got um, a good overall look with the momentum based upon what you have, a fast line, or what I call a fast line, which is the red line. Then you have a slow line, which is the green line, and how they interact together. And then you have a zero line, and whether it's above the zero or it's below the zero is another factor. And the crossings, the crossing of, say, the red line to the downside of the zero line. And where does that bring us? Right back up where things really start to break down. But yet, the green line, the slow line, is still above the zero line until it breaks down here below the zero line. Where's that? That's a pretty good, that's a little counter trend rally before a big move to the downside. So that was a pretty good indication there. And then probably my favorite indication, because I'm lazy, is the breakdown of the fast line over or under the slow line. And in this case, the fast line broke under the slow line as it went down. It broke the zero line, which gave you an initial indication that weakness was coming in. Sellers were coming in, and the buyers that hung on were in a little bit of trouble, I think. But the fast line stayed below the slow line the whole way down here. And that's where position trading comes in. You just take a position and just ride it down. It's a beautiful thing. Until when? Until the fast line crosses over the slow line and you have some chop. It's not going to immediately just spring back up. I mean, it does in certain cases, but in our case, it's just basically chopping until you get a gap, and they gapped it up, which I knew was not a good thing, and I knew it was coming back down. I think I even mentioned that in my post, my view from here post on Use ThinkScript. And they're not going to do it right away, but you know what? They did a pretty good job when they did finally get back to selling. But in the meantime, with the chop, you can make money on daily trades, on day trading, as long as the red line stays over the green line. And the green line starts headed back up until what? Until you peaked out here. You had a crossover to the upside of the fast line, and it peaked, which coincides with the peak in price here. But what did it do? It quickly broke back down. and then subsequently broke to the downside of the slow line. That's right here. That's, I mean, before I mentioned how the sellers pushed it back down. That's one facet. But the momentum was taken out. That was here. Whatever momentum that was, they took it out and brought it down. So that's a little glimpse of what I look at in terms of momentum. Let's go back up and we'll add the last piece to the puzzle. And that's A. Jordan 930s inverted VIX, which is another great tool. It just has a little bit of difficulty properly displaying properly. And just in certain circumstances, it still gives you good information. And what is it? It's an inverted VIX. If you don't know what the VIX is, it's the fear gauge. It's essentially options on the SPX, or the S&P 500 index. And it gauges the feelings that the traders have in terms of whether they're excited and pushing higher, or they're a little fearful and things are pushing lower. And that's what this yellow line, or gold line, whatever you want to call it, is tracking. I changed the color to this. On the stock indicator, it's not necessarily that, but this is the inverted VIX. And then you have a moving average to further delineate what's moving to the downside or what's moving to the upside. And then the nicest addition to this, instead of just having the VIX and the moving average, or the inverted VIX and the moving average, you have the application of the Bollinger Band. So you have a volatility gauge. Things get crazy volatile, like the Fed making a pronouncement. Friggin' Fed. The Fed makes an announcement and craters the market short term. That's what this is showing. And then what happens over time? Things calm down, the volatility comes in, and you get a squeeze. And to me, it's a nicer squeeze than the TTM squeeze indicator. But you know, whatever you choose to use, whatever floats your boat, whatever works for you, that's the way to go. Anyway, the inverted VIX breaks down here, and then it does something interesting. It stays below the moving average on the way down here, and they've got confluence with the momentum doing the same up here. So it gives you extra confidence that you can stay in this trade to the downside if you chose to get in short. That's what I'm talking about. Get your shorts on. Get short. That's the way to go, at least for now. And we'll see what develops, because the future nobody knows. Okay, so that's pretty much a highlight of what I'm looking at in terms of the inverted VIX. You got a crossover here. If you bring it up, pretty much coincides with the crossover on the momentum. And I don't think it's collinearity. I don't think these are necessarily collinear. So that's another good thing, because you don't want to mess around with collinearity. It's not going to give you the information that you're really looking for. But anyway, everything starts headed up here, headed up on the momentum, and you got a little bit of movement to the upside. I mean, if you got caught in the chop, you got bailed out with the gap up here. But, excuse me, I'm a little nasally. Anyway, what happened here on Friday? Crossed to the downside. Momentum crossed to the downside. So we may have, and this finished at the low, so we may have more downside to go. And I'll get into the Fibonacci's in a minute to show you what I'm thinking about that. But in any event, this is pretty much the setup that I have on a daily. Pretty much the setup that I have in general. 3 lower charts, or lower studies, and 1 main chart. And that works for me. And as a result of watching this video, I would hope that it works for you too, if you choose to employ it. But anyway, we'll close the study and strategy window here. And what are we going to get into? We'll get into Fibonacci's. Okay, we'll start out on the daily. And I'm going to squeeze things in a little bit here. Okay. Now the channel's telling us that it's basing here, and it's going to move to the upside. And we see how it got rejected. It actually came lower. And where did the low on this candle move in? The low right here. So you're testing the previous low, and some smart person told me somewhere along the way that price always tests twice. So you get the move to the downside, then it starts working its way back up, then you get another move to the downside, and it coincides with the previous low. Okay. So what I'm going to do is I'm going to right click on the Fibonacci. And I'm going to put in the 2618 or 261.8%. All right. Now that's a heck of a ways down. But I don't think that the 261.8 is where this stops. I think we've got a correction going on, and I think this is one stop. But before we make that stop, we have the 200%. And I think that's where this stops and bounces. That's what I'm guessing, at least. And you got to do your own due diligence. You can't rely upon me and my screwball ideas. That's what I'm thinking. I'm sticking to it. But that's what I'm looking at in terms of Fibonacci's. And going back to the properties window, I just use it like stairs. You're stepping up and down, support and resistance wise. And you're just checking off and unchecking off what applies as you go up and down. So, I mean, I can supply the coefficients for you, and you can just do this yourself. But you have to know where to draw the Fibonacci in order to get the proper levels. And that's something that wasn't easy for me for a long time, but I persevered because I just don't give up. It's my hard-headed Irishness. Anyway, okay. Excuse me. So that's a daily, and I don't trade the daily. I actually go further down. Even though I'm trying to swing or position trade, I go down to a 5-minute. But I keep the daily in mind, and I go out to the monthly charts when I really want to see the overall. That reminds me. I showed starting out on the daily. We take a quick look at the monthly, just because that's where I started out the thread on the view from here on the posts on Use ThinkScript. So let's go out for a sec. Things are going to break down, so I got to dial in and dial out. And I realize that we've spent a lot of time here already, so I don't want to make this something that you probably want to bail. You don't want to be sitting here watching this all night or all day. If this is a 10-year monthly of MNQ, no good, because there's not enough data. So what I do is I go out to NQ. And there's some anomalies, like the volume average. First of all, you're not getting the volume, but on top of that, you're not getting the average here. But that's okay. And the reason why it's okay is because we have it on the front end. And what do we have? We have the buying volume crossing under the selling volume. Pressure, pressure, pressure. And that doesn't bode well for buying the dip and long and so on and so forth. You really got to think more along the lines of short. At least I do. That's why I say get your shorts on. And in terms of the momentum, the red line, the fast line is really cracking to the downside, and the green line, the slow line, it's cracking to the downside too. Not as much because it's a slower moving average, but now what's interesting is the inverted VIX had kind of a move below the, the Bollinger Band here. It didn't register really price-wise, but it did register for me. What it showed me is there's divergence going on here. You got the big boys unloading to the retail crowd at the top, and really they start long before that. They start in the middle because they got so much inventory to unload. They've got to be able to do it in such a way that the retail is going to buy it all up, so they push everything higher. But then when they get ready, down it comes. So what is this showing me? This is a monthly chart, top of the channel. And you know what? I got a log chart on here. I'll go to a regular chart because you got a kind of crazy tailing off on the channel here. It may affect the channel. So let me just go into settings for a minute. I could have gone the other way. I'll do that. I enabled this to be under the style on the main menu, so I don't have to burrow into the settings. So I go to style, and I go down to use log scale, and it gives me a different channel, which is actually better. That's what I've been dealing with. What do they call this, a morning star or something? Shooting star? Whatever it is. Price pushed up outside the channel. Sellers came in, pushed it back down inside the channel. That's a good telltale of the weakness after this run. And we had a hell of a run for 2 years. It's natural that we're going to have a little bit of a correction. But anyway, and sure enough, that's what we're tailing over. And it's reverted to the mean, so we did that trade already. But I think we're getting into a trend, a corrected trend. That's already kind of broken the mean, so we're down we go. Where do we go? Well, we got the third standard deviation here, but we got the lower channel. I think the lower channel is where it's headed overall. Just like the quote-unquote bear market or correction, more of a correction, wasn't really a bear market. But it was 1 year of heading down. And what did it do? Gathered itself around the base of the lower channel and then moved to the upside. Well, this is coming down. Not the same exact way as this is coming down, but with this kind of big sell-off bar or candle, whatever you want to call it, and giving the indicators, it's coming down. But overall, long term, it's like they say about the market, keeps going up. Well, that's what the channel's showing, keeps going up. Then you have the 233 underneath, green. So it's over the 233. It's got strength. It's just got to take a break. And on a monthly chart, that can hurt a lot of people. So I don't necessarily like it. But you know what? Market forces. You got to work with it. Okay. So that's a monthly. And we'll go back. I should probably do NQ because then it can show you whether it's MNQ or NQ. They're basically the same thing. One is the mini, one is the micro, but the data basically is the same. NQ is better because it has more data available. You can do a longer term 10-year monthly chart where you don't get the same on MNQ. So if I go back to MNQ, we can see the difference. I mean, on the front end, it's fine, but on the overall, not so much. There's a lot missing here. But anyway, we can see our Fibonacci's then on the daily. We're looking, pretty significant. We got a 261.8 at 18,000. But what we got is a lower channel confluencing with the third standard deviation. I think that's where we come down to. We're talking about 16,000. So pretty significant move to the downside. And if you're constantly trying to buy long, you're going to blow up your account. And I would hope bad for nobody. Anyway, so we're back on MAQ, and I'll switch back. Or I don't have to switch back at all. We'll just leave this chart, and I can't access my other chart. The screen recorder that I have doesn't let me access my menu bar. Okay, let me see if I can work it this way. Maybe it's better to show you this way, so you get a full sense of what I'm dealing with. And when I pull up the 5 minute. Now, 5 minute, we already have all the indicators on. The 5 minute showing us, unfortunately, the inverted VIX has some difficulties. And what does it have difficulty with? Right now, the way I had this set up, we don't have any extended hours. This is just straight market hours, which I tend to prefer. But if I go up and we go back to style and I go to extended hours, all of a sudden the inverted VIX is fixed. So maybe I'll stick with the for the sake of this until I figure out how to switch between charts. In terms of I had a five minute already set up, and now I'm on the 5 minute. Oh, I had the daily set up. I'm sorry, and now I'm on the 5 minute. And I have all the studies and everything already applied. Showing the 233 is red overhead, so we know that's weakness. The candles are colored red. Not perfectly. I've yet to find a perfect candle coloring study. But for the purposes of what we're doing, this is showing weakness. The volume, this was Friday, pretty much started off selling off and then really plunged and just kept going the rest of the day. As far as what I was saying about the averages in terms of volume, you got the red line over the green line. We know that's basically selling going on. And as long as the red line stays over the green line, price comes down. You can get little dips here, little counter trends pop up. But as long as that red line pretty much stays over the green line, you're dealing with a situation where price is coming down, it's not going up. On the open, with the red line going to the upside here, you're just going down. And the green line not keeping up with the red line, average selling pressure, average buying pressure. You gotta remember, I can't just say green line, red line. People won't necessarily understand what I'm trying to say. Anyway, you have a situation where there's just more selling going on than buying. Even though it's a one-to-one situation, you're seeing the pressure is to sell, or the pressure is to buy. And the momentum going down. And because the red line, what's the red line, green line, 1, 2, 3, because the fast line is below the slow line, you just ride it down. Now it comes, you don't know that this is the bottom of the selling, and it's not the bottom of the selling. But for the time being, they're going to try and rally to the upside. And when they do, cross back over and bring it higher. And what did you do? You chop sideways. So you knew it was going further down. There was no time to get in here. Even though everything's pointing in the direction of going back up. This is where there's not confluence between the inverted VIX and the anchored momentum. Because why? Because the inverted VIX is really showing you what's going on. Selling, 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 selling. With the average just pointing down. But the inverted VIX itself pretty much revolving around. It based, and that's what happened here. You got some basing, but ultimately further down. Not as dramatic as on the open. That's where you really got the move. But you got the volatility first thing in the morning. But anyway, so you can follow this. The volatility is shown on the inverted VIX with the Bollinger Bands moving out here. and the inverted VIX being underneath the lower Bollinger Band, you really got an acceleration of price to the downside. And over the course of the day, that's pretty much what was happening. Just working its way down, just selling, selling, selling. A lot of people, getting hurt because they're taking short-term pain. They just can't take it. They want to get out. And I can understand that. It's a very human thing. You don't like pain. And you don't like financial pain, that's for sure. Not now when prices are going up. Prices at the store, that is. Okay, so this is a 5 minute. And then one last thing that we'll take a look at is the Fibonacci's. So what I want to do, I want to turn off everything here. Even though I would look at the Fibonacci's with respect to the studies and stuff, support and resistance. Drive the trend on now. We'll just leave the channel on. All right, that takes us back to where we started in terms of just price on a chart with a Fibonacci. Except we're looking at a 5 minute as opposed to a daily. And it's kind of nice to take everything off, strip it totally down. And why is that nice? Because you give more room to price itself, even though volume is critically important, just for these purposes in terms of support and resistance in the Fibonacci's. Just strip it away so you can really see what price is doing. You can see money here, that's what I see. This was a nice sell-off. Not so nice in certain ways, but if you're willing to sell the rip, here's the rip. Don't buy the dip, sell the rip, and then ride it down. Okay. So we have the daily Fibonacci up here. We have a 161.8 daily Fibonacci. And if I can access, nice, I can access the Fibonacci's at least. All right. So let's see. So we get the 5 minute Fibonacci's here. And what is it showing us? Well, it's showing us that we're actually coming from higher up, and it's selling off because we're at 100% here, and we're at 200% down here. So you got 100% Fibonacci move down to the 200%, and it based, and then broke that support and went lower, and you had the channel coming in. So you know that, at least I know, I think I know, that price is going to bounce back to the upside because it's getting away from the channel. And it's getting away from support here, so it may come up, test support, and then go lower still. We'll have to wait and see what develops on Monday. What do I want to do? I want to zoom out, and I want just market hours. So we'll go back up, and we'll get rid of extended hours. And now we have just market hours. But what do we have? I have a 5-day, 5-minute here, and I'm pretty much just looking at the last day. So what I really want to do is, I think I wrote it in a post on the thread that I have up on Use ThinkScript. I really like to see this almost as a line rather than look at individual candles. Even though I could zero in, once I get a good handle on the overall, I can zero in and start looking at candles and what candles are doing. So I'm going to right click, and I'm going to auto zoom. And this shows you right here. This is not a good channel for trying to buy. This is all about selling. And where do you want to sell? Well, obviously you want to sell here. That's ideal. Touch the upper channel and just sell off from there. You just hold. There's no reason to basically get out. Even though in some ways you get a little counter trend rally here like this, that can throw you off because you're thinking, oh my God, it's going to change the channel. It's going to go higher. It's going to do this. It's going to do that. Now, what did it do? It did almost a double top. Not quite. Double top would have been up here. But what it really did, and what you're going to look for, if you ask me, lower high. That's what this is, a lower high. And you really sell off after a lower high. So what do we got? We got order flow to look at. And I'm already at 45 minutes. I don't know if you're asleep or you basically bailed on this. I don't know if you want to hang in for the rest, but I'm going to do the rest because this is my beta test for doing video going forward when I could really talk about stuff. And this is an intro video. So I got to get into the nitty gritty as opposed to quickly updating, getting done. Alrighty then. So we'll get back to the Fibonacci's. I go from a 23.6 down to a 200. It broke the 200, so I look at the next level after that. And it's a 261.8 down at 19,100. That's what I'm looking for. That this downtrend is going to continue down to the 261.8, and then I'm going to look for a reversal down there. And I'm going to look for confluence. And I think I have confluence in terms of Fibonacci's even. I'm going to look for confluence as a real floor of support. So let's take a look, see if I can pull up the dailies. There we go. Okay. Got a lot of lines going on here. But you know what? It's a beautiful thing. It's support and resistance. And what do we got? We got the 19,100 at 261.8. We have the 200% on the daily at 1952. So you got a nice little buffer here, a little support bar, a little area of support based on confluence, I think. Not total. They're not like the lines are totally on top of each other. But you know what? It's an area to really be looking at. And what can happen is, when you get confirmation, let me see if I can pull up. Do an overlap of volume. Let's see, overlap the volume and show the subgraph. Okay. You just look at it, volume, pure regular volume, bar by bar, candle by candle. And when it comes down to this area down here, like I was saying, if you break the 200% on the daily and you see a big friggin' bar, a big volume bar, you know what? The big boys are buying. They're just waiting for it to dip down here. Trip the stops on the retail and start buying and bring it higher. Because that's how they make their money. I imagine they make their money shorting too, but it's less work to go long than it is short. And they're just into making the money. Can't blame them. That's capitalism. Okay. So that's something I didn't necessarily think about showing you when I first figured on doing this little video. But just wanted to show you because that's what I'm going to be looking for. It's like a situation where it breaks down here, and then all of a sudden you have a huge spike volume-wise, pushing higher, and it doesn't break down further. It's just holding in place, and it's absorption. It's absorbing to go higher. And you had this sell-off on Friday, and you had this big move to the downside, and you can see the volume that's involved here. Whereas you had a sell-off right at the open the day before, and then it rallied higher, and you had serious concentration of volume here. You had much more volume actually transpiring here, and you had a gap down. So that gap is going to fill at some point, I would think. So that's something to look forward to. If you're stuck up here, you may want to hold, and it's going to be painful, but you may want to hold because you want to see the gap getting filled here. Let me turn the volume back off. Nice to look at for a moment, but okay. Back to Fibonacci. So we have Fibonacci levels going on here. And like I said, I'm going to zero in on what I want to look at. Well, I put all of them up here just so I can show you how it worked its way, Fibonacci-wise, support and resistance-wise. Okay, and then it gapped over the 100%, came down here, and just sold off down to the 200%. So let's go back in to Fibonacci here, and we'll just focus on what we want to look at, which is the front end of the chart rather than the whole chart. So I'll take the 23.6 out, take the 38.2, take the 50%, take the 61.8, 786, the 886, and let's see what that gives us. A little better, a little better, but we can do more. All right, we're coming up on 50 minutes. Oops. We'll take the 100 out. We'll leave the 100 and the 200 in. Take the 41.4 out, or 14.14. 27.2 and the 61.8. Just want to show you the way they redid the drawing sets in Thinkorswim is really, it's good, but it's kind of difficult to friggin' learn because it kind of, it works, at least for me, it works opposite of what I would think it would do. I'm just gonna start turning all sorts of stuff off. You know what? Do that. If you're willing to hang in here a little bit longer, I'm gonna finish up here, but I'm gonna start from the beginning. All right. So we got a channel. We got price, unfortunately, moving to the downside. Unless you're short, unless you got your shorts on, then you're loving life. But in the meantime, so what do I want to do? I want to access, I think by turning all of them off. I lost my handle. I could go to the default, but let's see. I think I'm going to have to, unfortunately. Didn't think that went all the way through, so let me quickly. What I want to do. You know what? I'm kind of thinking on the fly here, so bear with me. I'm just going to start with the dailies, because overall this is, if we had daily bars up, it would be the same as the 5-minute bars, except the 5-minute bars are giving me what I want to look at in terms of almost like a line. And this isn't even really looking like the line that I would hope to have, so I'll show that in just a minute. But what I want to show you is the support on the 127.2 here is pretty good. The price moves off and hits the upper channel, comes down and breaks the 127.2, so you know it's going lower. But what does it do? It has to come back up and retest from the downside or the underneath of the 127.2, and then it sells off to the next level, which is the 14.4 or the 141.4, which isn't as strong a level as the 127.2. But then on the open, gapped it down, came up to retest, found support, moved up, but didn't get to the upper channel or the higher fib. So it's basically weak, and this is a lower high. lower high to this, and you get a nice little sell-off here. But the mother of all sell-offs, at least on this chart, is coming up. Why? Because you get back to the channel. You don't get up to the channel, you get close. But then you break to the downside, and you lose the 14.4, or the 141.4, and you gap down, and you really sell right through the 161.8, which is supposed to be a pretty good fib in terms of support, but not in this case, not on this day, and down it goes. So what's I going to do next? I want to do 5-minute fibs. Let's see if I can do 5-minute fib. That's going to take time I don't have. I'm going to have to redo that. And I don't want to screw up the default because that gives me everything I want to look at. But you know what? I'm only going to lose. I'll be able to redo this on my own. But I'll just show you. I'll get rid of the dailies here. I could save this as another drawing set too, but okay. So this is the 5-minute fibs, and it's showing you the 100%. It came down base, but it broke the 100%, and then it started free falling from there, straight through the 161.8, down to the 200, and I think on its way to the 261.8, down at 19,100. That's what I'm going to wait for. And we got 5 days up here, not enough data, because what I want to do is I want to show you order flow, and I want to do it with lines. So I'm going 10 days and see what it looks like. There we go. So we got lines going on here, and we can leave the Fibonacci's up. Unfortunately, the channel's broken for some reason. May not be enough data to draw it backwards, but we'll deal with. And because I don't have lower studies in, it's stretching everything out, but that's okay, because what I want to show you is order flow now. Let me see if I can pull up the order flow. I have to go into the studies. Let's see. All right, there we go. Let's apply that. Now, this is not what I want to look at. I don't have it optimized to show you. You have to wait for the next video. But at almost an hour here, if you've hung in this far, I really appreciate it. Getting a little impatient here. I got a little bit of a lag. I don't know if you guys are having lag with it's doing chart. It's doing the whole friggin' chart. That's why I hate multi-time frame. I'm just gonna deal with having to set the time frame. Alright. Well, that gives me a handle on what I need to do. I need to go back. This was done. Got a shout out to Snoopy Doopy, who came up with this hybrid profile optimized which is really a great study that he put together with Claude. I was thinking of Claude was a friend of his, but I think it's the AI. And let me see, I'm going here. Time per profile. I really want day. Just gotta go through the settings here for a sec. I don't think I want an hour. I don't think this is gonna work. We have to save. Yeah. I have to save volume profile for the next time. I can't access. Okay. But I think we covered a lot of ground, and I think it's pretty good in terms of an introduction. Hopefully, it'll be a good test for what I need to do on the back end in terms of putting it all together and getting it served up. And get rid of this. So what I'm going to do, I'm going to put the charts back the way I had them. I got to totally get rid of this. And let's see, go with the adaptive trend flow. Go with the EMA. That's what I wanted to show you. The 233 on the EMA. It's pretty interesting. So let me get rid of the adaptive trend flow for a minute. I mean, if you just followed the 233 and just stayed long, the 233 is green coming up like this. Grant you, it hit the top of the channel, get out of town. But if you wait around and it sells back off and you got out here and you got short, that's a nice friggin' drop. So there's that. And you have the Fibonacci's also. So even if you did the Fibonacci's and the 233, you got a nice little system there. Not as precise as having everything, but then again, nothing is. Let's go back to the daily fibs. I mean, bases here, breaks here, tests here. It just, this turns red on this test. That's telling you, get your shorts on. Boom, down it goes. I know it's, looking at history, it's easy to kind of say, oh, I'm going to get in here, I'm going to get out there, so on and so forth. But if you zoom in, maybe I want to zoom the other way. Say we take this much. We're right on the front over here. We don't know what's going to happen over here, especially with just having a 233 and a fib. We don't have any indicators. So what do? Do a bar at a time or a couple of bars at a time. Comes down, maybe expect to bounce here because it hit the lower, hit the 161.8. Well, if you got in, get out because it broke it. And down it comes. So you can do a little on demand without having to bog yourself down in the on demand, tool that Thinkorswim has. You just do your own little on demand just by advancing the chart, you know, step at a time. Go down here to the, actually it's below the frame of the video, but I can just advance one at a time and just see how it interacts, everything interacts to give you a better handle on where to get in, where to get out, hopefully. And I can't do the order flow today. We covered everything else I think that I wanted to cover. And we're just about 5 minutes over an hour here, 64 minutes. So I guess that's it. And I want to thank you for stopping by. And I want to thank you if you've hung in this long to watch the video. And I'm going to post this up. I'm going to work on getting this put together properly, and I'm going to post it up, hopefully, if Ben 10 and Mary Day and Use Things script will let me post video. I'd much rather do videos than try and put together a written write-up. So thanks for stopping by, and I wish you much luck in your future endeavors. And whatever you're doing, I sure hope you're having a good day doing it. And that's it. So take care.